Welcome to this week's edition of Trade the Trend, a weekly video discussing where the stock market is heading. I'm Jason McIntosh. It is Friday the 13th of May 2022. As always, this is general commentary and doesn't take your personal situation into account. All right, with that said, let's jump over to our first chart. And so we've got the S&P 500 up on the screen, and it's been another big week in the S&P as well as global equities in general. And the S&P 500, well, it just carved through this support zone that we were speaking about last week. So it was only a relatively minor support zone, but nonetheless, I thought the market may have been able to muster up some sort of a bounce. If you remember what we were speaking about last week, I'd highlighted that we had this first leg of the decline was in a zigzag shape, and I thought we may have from here had a slight bounce upwards, maybe over a week or two, and then from there maybe we'd start another decline down to this region down here, this 3,900 region, but that's not what happened. The market's just cut straight through support, and we didn't get our double zigzag. And look, that's just the nature of these bear markets and these corrective periods. They're just so unpredictable in terms of they can be quite erratic, and they just lack that consistency of a rising trend. So plotting the course is just always that much more difficult. But I think overall we could say that scenario that we've been talking about of this big corrective phase from the COVID low, I think we could say that's been playing out pretty much to the script of what we were looking for, in that when we put the Fibonacci's on, we can just put the Fibonacci retracements on that entire rally, we can see we're now getting very close to this 38.1% retracement, which is the upper boundary of the Fibonacci zone. And it's interesting, the S&P 500 got within a whisker of a 20% decline last night, on Thursday, during Thursday in the US. And what 20% marks? 20% is the technical definition of a bear market. So it got down to, it was around 19.8% or thereabouts. So effectively, you'd say the S&P 500 is now in a bear market. Technically, it needs to go a touch lower, but that's probably splitting hairs, because when you look around the globe, you look at other indices in the US, you look at the Nasdaq, you look at the Russell, they're both down over 20%. Look into Europe, we've seen markets down over 20% from their high to their low. Same can be said for Japan. It's in Australia, a lot of stocks are down by over 20%. So this whole global equity scene is very much, well, it's very much in correction, and there are pretty much bear market conditions all around. And what's been happening is this has been unfolding faster than I thought, but it is now reaching a point where it's completed a measured move, which is really interesting, because what we can do, this is a level we've been speaking about for a few weeks, in that we can get a technical measured move. So we use the high point, and we come down to what was a swing low, project up to the upward reaction off that low, and then we can project down again, and that gives us a measured target. So this is a technical measure which we can use for getting an idea, identifying potential levels that the market might get to. So these are by no means magic levels. They don't work like a magnet or anything like that, and there's certainly no guarantee that the market's going to get there, but quite often they do give us a good guide. So it's interesting to note that the market is at this measured target now, which is also just above this Fibonacci retracement zone. So whilst I've been wrong in my optimism for a bounce over the last couple of weeks, I did think we could get a bounce here, and previously the week before I thought we could have got a bounce here. So I've been looking for bounces before the decline, but the declines just kept rolling on without the bounces. But at some point there is going to be a bounce, and I still think it's due. The market does appear to be quite oversold at this point down here, and we are getting quite stretched from below these moving averages. So the further away from the moving averages the market gets, it's like the elastic band is being pulled, and at some point there's going to be a mean reverting rally which slingshots it higher. So by no means does that suggest there's some new bullish phase starting. I think we're a long way from that, but it's just to relieve the short-term oversold conditions that the market appears to me to be showing signs of that oversold state. So this would be a very natural place for that rebound to happen, if it's going to happen. Now, I also look at some sentiment gauges, which sort of gives me a bit of a feel that this could be what we're looking at now. And so let's just go down and find them. So this is the number of stocks in the S&P 500 which are above their 20-day moving average. So we're pretty much at rock bottom. Currently, there's 11% of stocks above their 20-day moving average. We got down to around 6% during the day. So this is about as low as this indicator gets. We can compress that data a bit, and you can see, like, this is during the COVID crash. It locked down for a period of time for several weeks. But ordinarily, you really only get a touch within this zone before the market rebounds. So this is one of the reasons why I do think the market's overstretched and this rebound is coming, unless we take the view that we are going into another COVID crash phase type event. And I don't think that's the case, because crashes typically don't happen that close together. The COVID crash was still only a couple of years ago. It'd be highly unusual to get two rapid crash style events so close to one another. Anything can happen, but if we're working on the basis of odds and probability, I think the better play is that a bounce is due. Interesting then to look at the number of stocks above their 50-day moving average. So last week you might remember we were speaking, and this is one of the reasons why I thought the correction still had further to go, and I do think it still has further to go, in that the number of stocks above their 50-day average still hasn't got to an extreme. It's getting low, and it's getting lower through the week. So we've moved from 24% thereabouts down to around 15%, but there's still scope for it to go lower. So let's put this on a weekly chart and see where we are. And when we compress this data, so it goes back to 2007. So it gets the GFC period in. So this would be the GFC lows, somewhere around about through here. You can see the market does come back here every few years. We haven't been down here since COVID. It does look like it's due for a test into this region, but we're not there yet. So one scenario which I think is possible is that we do get a bounce. We do get some sort of reversion to the mean type rally. It could last several weeks, several days, several weeks. Who knows? We don't know the time frame. But then after that, we do get another round of selling. Maybe it's in the middle of the year. Maybe it's next week, for all I know. We don't know. This is just looking for possible courses the market could take. But if we were to get a bounce, then we could get a retest of the lows from this week later in the year, and then that could potentially be the event which brings us down into this region, which is where we really start looking for some sort of a lasting low point that the market could start to construct some sort of a more sustained rally off. But I don't think we're there yet. Let's go and have a look at the number of stocks above their 200-day moving average. And it's a similar sort of story to the 50-day average, in that you can see the market does get down here to test it every few years. We're getting close. It looks, I think the market will retest this region before this is all over. And once we're in there, then we really start looking closely where could signs of a lasting low be. But again, I think it's too early. I don't think this is going to mark the end of this current corrective / bearish phase. I think there's more in it. Although from a short-term perspective, maybe there's some sort of reprieve before we maybe dip into this level in the weeks or maybe even the months ahead. Time will tell. So I'm not looking to buy into any potential rally that could occur over the next week or two. I'm simply looking for this counter trend rally to last a relatively short period of time. I think we need to remain defensive in the way that we approach the market. It's just not in a situation at the moment where I'd be looking for this to turn. This was a large sustained rally over many months. It needs time to work its way through, and that will happen, but it is going to take time. And so if we do get a bounce, I'll be using it to exit a handful of stocks which are in my portfolio, which I'm mis-selling on the way down. Like some of the less liquid stocks I've got, the opportunity to sell them just didn't seem right, and I held off and the market moved away from me, so I've been left with a few stocks. So now I'm looking for that technical rebound to unload some stuff. So that's what I'm looking for, to unload into a potential rally, and then assess the market from there. It's not a case of taking a whole lot of new risk at this point. And another reason I think to be defensive is something else which has occurred during the week. It's going to go back to a daily. I'm going to call up a chart of Apple. So Apple's the largest stock in the S&P 500, and it broke down through the week. So there was this support zone through here around 150, 155. The market has now broken below there. The moving averages, the 50 and 100-day moving averages, now appear to be crossing to the downside. So this is now technically quite a weak structure, and being the largest stock in that S&P 500, it's hard to see how the market is going to make a lasting low at this point, with Apple just having broken down. And then you look at stocks like Microsoft and Alphabet, which is the company Google operates under. They've also broken below supports, and they're below moving averages. So it's, as I say, look, this is still a time for defense. It's not a time for looking for lows. So I don't think we should expect the continued one-way traffic we've been seeing in the S&P 500. So this has been quite a one-way trip down. It's like a 16% fall in 4 or 5 weeks. So I don't think we should continue to see that one-way traffic to the downside. But I do think it's going to it could take quite a few months of work to get through this period. And look, if you're feeling knocked around by the falls we've been having and the volatility that we've been seeing in the market, just remember, look, you're by no means on your own. I'm feeling it. I think just about every investor is feeling it. They're really unpleasant periods to work through, and just to show you, it's also the professionals are finding this really difficult. An article I saw through the week which was really interesting. It's about a hedge fund, a big hedge fund. So this is the Tiger Global hedge fund, and just this year it's lost $17 billion due to this crash we've had in a lot of those technology names. And really interesting story. Just Google it, go to MarketWatch, you can find it. So what's fascinating is that in 5 months, they've lost roughly 2/3 of their cumulative gains that the fund had made since 2001. So, look, 21 years worth of gains up in smoke in 4 months. That's just extraordinary, but that's the type of extraordinary market that we're in. Bear markets hurt just about everyone. We know they're part of the cycle, but it still doesn't make that much easier. It's they're just tough, and the key is to use strategies to come out the other side with most of your capital intact and also your emotions intact. And then if you can do that, then you can, you're hopefully ready to take the new opportunities when they inevitably do emerge. And hopefully I'm helping with this. Hopefully I'm helping you, guide you through this period, and hopefully I can help you come through the other side. So let's jump back to our charts. And look, if you're getting some value from this, please hit that like button, and please leave a short comment. Let Google know, let YouTube know that you're leaving a comment. Lets YouTube know that you're engaging with it, and then YouTube shows other people, and I make more videos. So please do that, it really helps. And if you haven't done so yet, jump over to my Motion Trader website, motiontrader.com.au, because I've got lots more stuff there that could help you through these periods and help you find opportunities, which is what it's all about. So let's now jump over to the ASX 200. And after holding firm for quite a few weeks, ASX 200 has been one of the best performed markets in the for the developed markets. It's been holding up really well until really this week, where it's given way, and we've had some fairly fast and aggressive sell-off. But look, even with that said, it still looks like one of the better performed markets. So what we can do, we can put some support on and see where we're at. So there is support for the market, comes in around this 6,800 sort of mark. Yeah, around about 6,800. And we can actually carry this support along. So you actually see it's quite a meaningful support zone in that it picks up some highs from pre-COVID. Market bounce, picked up a little bit of a low point there. Then it's got highs through here, a low here, and then so on. So this is quite an important area, and I would expect the market to, at least initially, get some sort of a bounce off it, which we're currently seeing during Friday day in Australia. We do look like we're getting some bounce. Maybe that plays into that rebound scenario which I was discussing for the S&P 500. I don't expect this area to cave away easily or quickly. We don't know, but that would be, look, I think the base case would be we do get some sort of a rebound from here. And look, maybe it's a case that the Aussie market is going to trade sideways to lower for a period of time. I think the upside is certainly capped for now, but what's been supporting the market it's really been underpinned by some of those large banks, some of the large financial stocks, and the miners. So just looking at a stock like BHP, for instance. So up until just 3 weeks ago, it was up at all-time highs. So it's been trading quite well. It has pulled back with the sell-off we've seen in commodity markets, and that's one of the reasons why the Aussie market has started to slip a little bit. But the losses have really been in other stocks, not the big resource players. And then you look at a stock like CBA, Commonwealth Bank, and likewise it's been holding up near all-time highs. It looks very corrective, this pullback. It's above its 100-day moving average. So these are the stocks which have been underpinning the local market and making it look like one of the better global markets. But when you look under the hood of the ASX generally, and you look at some of the small to mid caps, it's you got the same scenario we're seeing elsewhere. So this is the ASX Small Ordinaries, and it's down close to 20%. So it's looking more like the sort of price action we're seeing in the S&P 500 and some of the other global equity markets. So this negative situation, this negative price action, is very much in Australia as well, although it's not so evident when you look at the S&P 200. And we can also draw some support on this chart. So I'd expect, you just have a look at this. Yeah, perhaps let's have a look at this. Yeah, there's probably going to be some support for this market, kind of around where we are now, around this 2,900 sort of mark, picks up these highs. A lot of work was done through this region through here. Small work here. It's probably some support there. Putting some Fibonacci retracements on from those COVID lows, and you see this market is also getting close to its the upper boundary of the fibs. So again, there is a story to be said for a potential rebound and a relief of an oversold position in the near term. And now, what I want to do, I want to go over and look at the US dollar, because that is, I think this is a central part of the story of what we're seeing in equities and in commodities at the moment. So what I'm going to do, I'm going to put this onto a weekly chart to really get the story of what's going on. Let's compress that. So this chart goes back to, I think we can get a little bit more data if I go on a monthly. Let me just have a look. Here we do. So for a really big picture, we can go back to, it goes back to, 1967, the history of the US dollar. And we don't need all this data for this analysis, but just to give you that initial big picture overview. So I'm going to go back to a weekly, so we're going to kind of probably get this period forward, because that's just a little bit too much for what we need to go through. So yeah, look, here's so during the 2000s, we had a big bear market in the US dollar. Then we had this basing period through the around the time of the GFC, and what we've had since then, we've had this gradual shift upwards. But it's really gathered momentum over the last few months, where we've seen this strong rally through here and a breakout of this range. This range had held the market since 2017, so a big range, and we're now broken to the top side. So this is the highest level for the US dollar. This is the US dollar index, so it's a basket of currencies. The euros, I think the euro is the largest component, followed by the yen, the pounds in there, the whole lot of trading partners of the US there. It's an index of all these currencies. And so the US dollar is at its highest level. You've got to go all the way back to, 2002, so 20 years, the strongest level in 20 years. And one of the reasons we're seeing this tightening in global liquidity as US interest rates are now being, more rate hikes are being priced in. It's tightening up global liquidity, and that's putting pressure on stock markets, and the stronger dollar is putting pressure on commodity markets. Also interesting, this period here marked a corrective period in the in global equities around late 2014, early 2015, and we're seeing another bout of that corrective period now with again this really sharp move higher. It's interesting though, like this don't just because the US dollar is rallying though, it doesn't mean stocks can't stabilise and can't ultimately go higher. This period we had here during the mid to late 90s was a rising period of US dollar, but it also coincided with the 1990s boom in equities. But at the moment, it's very much weighing on markets. This strength in the US dollar is a weight on the markets. The speed of this rally, just jumping to a daily chart, the speed of this rally has been incredibly impressive, but it's also, speed of rallies often also leads to consolidation. So all this may play into that potential for a near-term bounce in equities. And just showing how this is affecting, look, it's affecting pretty much every commodity. Oil is maybe one of the commodities which is holding the best, but most commodities are being buffeted by this rally. And just quickly having a look at gold, because this is one of the ones which often gets impacted by that strong US dollar, and it has broken lower during the week. So last week we spoke about gold was holding above support at around 1850. It's now cracked below there. We're now back within this range, which the market had been in for close to a year prior to the breakout we had. So look, you'd have to say this breakout has now failed. The market's lost the upward momentum from the break, and we're now back within the range. So I think I still think that medium to longer term outlook for gold remains positive. Just quickly looking at this on a weekly chart. When you look at this on a weekly chart, that still remains an overall a positive pattern. These are strong uptrends with pullbacks, with corrections, and this just hasn't finished working its way through. So the alternate scenario we've been talking about for several weeks was possibility of a washout down to retest those lows from last year, and then from there maybe we can look at the possibility of gold moving higher. So that would now be the case that we look for. Will gold come back and retest these lows? And from there, it does have that medium longer term potential to re-engage. But for now, I think we need to take a neutral stance on gold, as well as many of those other commodities as well. I think we need to accept the market's verdict that it's just not time for commodities like uranium and copper, and they potentially remain in holding patterns. Do some more work, and then we can look at the potential for them moving higher, whether it be in several months later in the year. We just need to wait and see. So look, I think this period is going to lead to some terrific opportunities in commodities, but all that's going to happen on the that's all going to happen on the market's time frame, not ours, as it always does. So look, it's a difficult period, but the key is to come through with much of that capital intact, using those strategies to minimise risk, not going in there trying to buy the low, chase stocks which are falling. The market will tell us when it's time. It's not time yet. It's time to protect capital, be cautious, be defensive, and this period will end. They all do, and we'll come out the other side with plenty of new opportunities, if history is any guide. So thanks for joining me this week. Let's leave it there. It's been great talking to you. Please give me that like. Come over and visit me at motiontrader.com.au. Look forward to talking to you next week. Until then,